It's Wednesday, and you are logged into Burr Cashflow Investors. So, as we get started, every single week on Mondays, Wednesdays, and Fridays, we do a Q&A where we have everybody from the group send us a bunch of questions, and then during this time, we address those questions. So, if you have any friends, family that are interested in real estate investing, and you want to know, you have any questions you would like me to address, share, we will do so. And most likely on Friday, we're going to have Gina Diaz from Diaz Case Law here, and we will have her address a bunch of the issues that people had talked about in terms of tenants with Section 8, and also as far as evictions that people had asked in Chicago and out of Chicago. So I'm going to have Gina address those. I'll have also Rahul kind of cover a little bit about the vouchers and Section 8 on Friday. So I had promised you guys that we will arrange that this week, so that's when it's going to come. Okay, so let's look at a couple of the questions that came in. Number one question was, and this is a question that's often asked, I'm a new investor. Do I need to create a LLC or should I wait? So it depends on, by a new investor, how new you are. My belief is this, that before you start spending a lot of money, you should think about, do you have money coming in first? Now, fortunately, with in the Illinois, it's become fairly inexpensive to get a LLC set up. It's never a bad idea to have one LLC, a simple, straightforward LLC, not a series, not anything. And I'm not going to get into a whole kind of dissertation about the series and all that kind of stuff, but I think you should set up LLC. Some basic considerations for you to think about. So let me maybe just draw this out. Maybe easier. Is this connected? Okay, so while the screen is turning on, I'm just going to basically just explain something very, very briefly. So let's just say you're Mr. Investor. This is you. It's a, what's going on with this thing? It's A and B, right? You and your wife, let's just say, right? And you have a home that you own, you have a couple of cars that you have. So this is you, right? So what you have to think about is that, am I going to be using an LLC? And here's how I'd like to answer this question. Are you buying this property as a rental property? Are you buying a property as a flip, depending on what you're doing? If you're going to do a flip, for sure, my suggestion would be is open a LLC, a simple, straightforward LLC in Illinois. If you're going to do a flip in Illinois, have an Illinois LLC. If you're going to do it in Indiana, do it in Indiana. Florida, then have a Florida LLC, right? Because when you open an LLC, what the state is giving you is, it's giving you separation from you. And this is something that a lot of times people get confused about is, asset protection is what we always hear. So there are a couple of different things that you have to think about. One is asset segregation, and then second is asset protection, right? So what does segregation means? When you open a different LLC, you're segregating that from you personally, right? So in case of a lawsuit, in case something happens, you are not being sued personally. Basically, if there is a property and there's something against the property, right? It is contained within that LLC, and that LLC is what gets sued. So this is important to understand. So generally, if you're going to do a flip, I would suggest separate it out in a LLC. The cost of it is very, very minimal. And the great part is that you will have some separation. Now, if you're going to buy the property and you're going to do a long-term loan and you're going to do a residential loan, right? If you're going to do a residential loan while you're buying the property, while you're while you're putting a loan on it, and all that kind of stuff, even if you buy it for cash and you're going to refinance it with a residential loan, it must be done under your name. Now, once you have that loan in place for the long term, you could move it into a LLC. So if I was to kind of take this further, the way The way I do it is this. So this is, let's say, me, right? And then the way I have it is I have an LLC here, LLC here, LLC here, LLC here, and another LLC here, right? So this first LLC, we'll call it Pinnacle. Pinnacle Real Estate, Pinnacle Investment Chicago, right? I use that for all the flips that are going on at any one time. So I may have about 12, 15 properties that I think right now I have somewhere around 15, 16 properties that I bought. So all of them all are here. Now, even when they're being rehabbed, even if I'm going to basically keep the property as an Airbnb, or if I'm going to keep the property as a rental, what I tend to do today, because this is a little bit more complex structure, hence I do it this way, that I'm basically buying all of them in one company called Pinnacle. That's where I buy all of them, right? And if it's a flip, I'm going to basically flip the property. It's out anyways, right? You have a gain over there, so it becomes simple for your taxes. But if it's a rental property, it's being rehabbed. At the time of rehab, it's here. When I refinance the property, then I'm going to basically move it here. So, and then that's going to be a separate LLC, 2, 3, 4, and 5. Generally, I put about 5 properties in one LLC. Now, I know if you talk to any normal accountant, a lot of attorneys, they're like, well, you should put 1 property per LLC. Now, mind you, most people have maybe 1 or 2 properties they own. People in Mastery or somebody like me, when you own 200-300 properties, it's not practical. What are you going to have? You're going to have 300 different LLCs? That would not be practical, and that would be ridiculous, right? And it goes further beyond that, that whenever you look at owning a lot of properties, running a bigger business, you have to look at it from a standpoint of not only asset protection, you have to think about asset segregation, and then you have to think about, in case I get sued, what happens at that point, right? How does it work? Because most people normal people that don't own a lot of real estate, or that have not run very many businesses, they've not generally been in a lawsuit of this type, right? And so generally, they don't understand it. They hear stories and they're afraid, oh my God, what if, I lose a lawsuit, I'm going to lose everything. That's not how it works. So let me just explain this, how it's going to work. Let's just hypothetically say, and then I'll come back to this because it's an important topic. So let's just hypothetically say you have a LLC and you have number 1, number 2, number 3, number 4, and number 5. Right? Let's say you hypothetically have maybe a couple of rentals that you're rehabbing and you have 3 flips that are going on. Let's just say for some reason, okay, somebody is there and they, kind of basically hurt their finger, right? And hurt generally, the injuries are going to be relatively minor. Relatively. And I said relative, meaning that if somebody basically loses a thumb from a construction standpoint, now for the person who lost the thumb, it's horrible. But when we come to this place of quote unquote lawsuits, it's relatively a smaller thing. Does it happen? Happens in construction trade, and it happens, it happens. It's just one of those things. So let's just say something happens, and let's just say that's on property number 1. And let's say your LLC is called ABC LLC. So what's going to happen? At that point, what would happen is your ABC LLC and this property address is basically, it's going to get sued, right? Now, what's going to happen is the insurance company that insures this particular property, you're going to turn over that lawsuit to that insurance company, right? Because that property is insured. Now, that's assuming that you haven't lied to the insurance company. You have builder's risk policy while the property is under construction. I'm assuming that you have done those type of things and that you have done them correctly. So assuming that you've done those things correctly, generally that insurance company is going to take over that lawsuit, and they're going to deal with whoever the attorney is that basically is suing the ABC LLC. Now, you may be the owner, but yet if you haven't done anything incorrectly, you are not getting sued, the LLC is being sued. I mean, think about this. If you work for a major company, is it possible that there are any lawsuits against that company? Yeah, it's possible, right? That's just, it happens. You're a bigger business, it's going to happen. That has nothing to do with you as an employee. Now, in this case, you're not just an employee, you are the owner of the company, and you may be 100% owner. Even then, right? Does it necessarily, if you haven't commingled your funds, meaning you haven't basically used your LLC like a piggy bank, personal piggy bank, and you have a separate company, then it's going to become an issue for the LLC to deal with, not your particular issue. Now, any of the assets that are other assets in that particular LLC, can they be affected if you lose the lawsuit? Can they be? Yes, they may be affected. Why? Because these are all in that particular LLC. Now, what is the likelihood that if you have a proper builder's policy, which is liability policy, that your liability in that particular property is going to be over $1 million? The likelihood and statistics, and understand the insurance business is all about statistics, right? Because the insurance companies are in the business of basically collecting a premium and not paying it out. A lot of times when that statement is made, people don't understand the statement, right? What they don't understand is that's the true business they're in. Why? Because an insurance company collects premiums from 1,000 people, and they're hoping that nothing is going to happen so that they can keep the premiums, right? That's the business they're in. But guess what? At times, the way that business works is they're going to have to basically pay out a certain amount of the claims and hopefully those claims are less than the amount they collect, and that becomes, after administrative cost, that becomes the profit for that insurance company. So that's how that works. So generally and statistically, what's going to end up happening is the lawsuit is never going to see the light of day. It's probably going to get settled, meaning you're not going to actually have a trial. It's probably, in 99.9% of cases, lawsuits are settled before they actually go to trial. Why? Because trials are prohibitively expensive, and either party, there's absolutely no guarantee after spending that kind of money that either party is going to win that particular lawsuit. That's just how it is, and lawsuits are very unpredictable and very expensive. Hence, they get settled in most cases. So that's kind of what it is. Now, can you get an additional policy umbrella or on top of this to ensure that, oh my God, I'm that worried? Yes, you can, but in most cases, it doesn't make sense, because if you have an asset that is worth $250,000, and you have $1 million policy on top of that, which is what your regular liability policy is going to be, then you're covered. You're pretty well covered. You're covered 4 times over compared to what your liability is. So, I mean, now if you still want to get an umbrella over and above, you can certainly do that. So generally, it's a good idea to have that. Now I'm going to come back to where I started, and that was here, right? So generally the way I have it is I have a company that basically has all the flips and all the properties that are under transition meaning under construction. I keep it here. When I'm going to refinance it, I'm going to move the property from here to this one. So it's going to be something like CF1, CF2, CF3, CF4, CF5, CF6, right? These are all different LLCs that the property gets moved to. And that's kind of how I do it. Now, you can do it a more complicated structure. Now, if you want to get a little bit more fancy, if this is you, now you can add one more layer to it, which is, instead of you being the owner of these companies, you can put a middle holding company in the middle. And this holding company, and this is where you may have heard, can be in Nevada, can be in Delaware, can be in somewhere else, that you're the owner of this company, and then this company in turn 100% owns these particular company. So what happens is this, that when a lawsuit happens, and let's just say for some reason you have a huge big loss, right? Courts generally do not want this thing to be sued if there's a problem here, and they don't like to go this way, right? If there is a owner here, then to go to the owner becomes much easier, but for them to go up the chain to another LLC or another holding company, generally the courts don't like that. Hence, they use a method of a holding company. A lot of bigger companies will use that. If you're somebody that is just starting out, you don't need all this nonsense. Just have one LLC and just do it that way. And that's a very simple way of operating. Keep it clean, become very profitable, and then start multiplying, and then start making your structure a little bit more complex, because now you have something more to lose. So that's just my personal opinion. Now, the next question was, what do you prefer? Do you prefer rentals? Do you prefer flips? And why? Right? I mean, for anybody that knows me, I always prefer rental properties, and prefer meaning that that's truly where your long-term wealth comes from. I started with flips when I started because I needed to make money with real estate, right? I was a real estate agent. I quit selling houses, so I needed to make money somewhere, and I used flips at that time from 2008 to about 2011 to basically kind of generate a lot of capital. Today, we teach it a little bit differently in Mastery. Today, we say you should do both. And if you have a day job and you're okay with your day job in terms of your income, then don't do flips, because it's going to take up your time. You can do rentals, and you can become, if you want to basically be independently wealthy meaning that you want to develop a cash flow income, it's much easier to do that with rentals, and it's much quicker to do that with rentals. With flips, you're not going to do that. You're going to make earned income, but you're not going to be able to retire with real estate with flips. So I prefer rental properties, but you have to do flips sometimes to supplement that. Last year, or actually this year, I had a lot of Airbnbs going on, a lot of them that are going to Airbnbs. They suck up a lot of capital. So generally, I don't do flips. This year, to supplement a lot of the income that was going out to set up this many Airbnbs at this short amount of time, what I've done is I've done a few flips. Not a lot, but a few flips. This year, ending this year, going into the next year, probably I'll end up doing a few flips, few meaning 8 to 10. Now, for me, obviously, at this point, doing 8 to 10 flips a year is not really that big a deal because obviously we're dealing with more volume, but that would mean somewhere around 500,000 to 600,000 in income. Now, for somebody that has not done it, this is not your business, that may seem like, oh my God, that's a lot of money, Andrew. That is not a lot of money. In relation with what we do, that is not a lot of money. That's enough funds to basically be able to float the business, keep building the rentals, right? That is not a lot of money, $500,000, $600,000, $700,000. Now, if you're somebody who is new and says, oh my God, I'm going to go out and duplicate that, good luck. Right? It's probably not quite that simple. I've been doing this obviously for a while, hence I can say that is something doable. But that means you need some capital, you need the wherewithals, and you need to know what you're doing. So the way we suggest is you do 2 flips, 1 rental, 2 flips, 1 rental, and then you flip that. Then you do 1 flip, 2 rentals, 1 flip, 3 rentals. So the way I do it is maybe 1 flip to 5 to 6 rentals, 1 flip to 5 to 6 Airbnbs. That way, what I'm doing is I'm using the money that is coming in from the flips, some of the additional 30, 40, 50,000 bucks, $60,000, I'm using that to be able to set up more properties, not because I need that money to live on. I have other income. I have a lot of passive income, so I don't need that money to live on, but I'm using that because there's a frictional cost in business. What does frictional cost mean? Frictional cost means is that you have to pay for attorneys, you have to pay for title costs, you have to pay for just the interest rate while you're holding the property, you pay taxes. All those types of things are called frictional cost of doing business. Just because you're owning the property, you're going to incur a lot of expense, and especially when you're doing a lot of them at any time, they add up. So for that, I generate the revenue from doing a a few flips. That way it kind of offsets some of your other revenue. Plus for staff and other things on that side of the business, that's how I offset it. So hopefully that makes sense. If you haven't attended one of the RIA meetings, please attend those, because this question will get answered. Because what you see in Mastery is a lot of people will do flips and or some supplement some income with wholesales, and then they divert the money to either live on it, or they divert some of that money towards helping them keep building a rental portfolio. The next question was, this person is buying a property. They're buying a property for $232,000. And they're saying that they're probably going to need about $65,000 to $70,000 to do a rehab. So I'm not going to disclose the address because they literally are getting the contract signed as we speak. And the question to them was, there was a couple-fold question. Number one, is this a good time to buy? I think this is an excellent time to buy if you're going to do a flip, because now your flip is going to be ready maybe end of January or so, February, which becomes the best time to be able to sell the property. You can kind of raise the price maybe 5-8% more than where the numbers are today. And that really helps you selling into the spring market. So as far as timing, your timing could not be better. Your timing is excellent, number one. Number two question was that they had sent some pictures. They're like, Andrew, what do you think the rehab on the property is going to be? So when I looked at the pictures on this particular property and the rehab, and for those of you that are wondering where's the property located, it's kind of in the northwest part of town. It's a property coming from the MLS. Hence, I'm not giving you the exact town just because I want it to work out for these people, obviously. So that's why I'm not giving you that information. Otherwise, we're happy to release the address. Maybe if they get it under contract, everything is good to go, we'll be happy to share that address. It'll be fun to look at the success story. And what they asked was for the amount of rehab that needs to be done. So this is a 3-bedroom, 1.5-bath property. Number one, my point to them was, I think you should make it a full 2-bath because you'll increase value. There's another bedroom that can there's another room there that can easily be made into a 4th bedroom. So now you're going to have basically a split level property. You're going to have another bedroom you can get out of it downstairs. You're going to have 2 full baths. That's going to be add tremendous value to the property. And what their point was, what do you think about the rehab based on the numbers, based on the pictures? Based on the pictures that they sent me, I think there's $65,000 that they're going to spend on it. They're overspending on the property. I believe, this is my opinion, based on the costs that I pay, and this person happens to be from Mastery. So I don't think they should be spending more than $48,000 to $50,000 on this particular property based on the pictures. Now, if they're doing something more that I don't know, I'm not going to say, but the rehab that they're showing me is all day long a $45,000 rehab. And even with maybe a little bit additional cost, maybe even at 50, they should come in. Now, the third part of the question was, well, how much do you think we should be making on a property like this, right? So what they wrote is, oh, we would be very happy with a $30,000 profit. So I'm like, hey guys, wait a minute, right? You're buying the property for 200 something. Then you're going to dump another, according to them, another 65,000 into it. I think that number should be no higher than 50. So your all-in cost would be all-in cost, meaning your purchase cost and your rehab cost is going to be somewhere between 280 to 300, right? If your cost is going to be 280 to 300 and you're only going to make a $30,000 profit, or you're saying you'd be happy with the $30,000 profit, I think you're absolutely missing the boat. Absolutely missing the boat. To hope for a $30,000 profit and that's how you're buying the property would be a huge mistake, right? To me, on a property that you're basically, so there are 3 things you have to consider whenever you're doing a flip in terms of how much profit is a reasonable profit. And reasonable meaning for you, it may be different. For me, it may be different. But if you want to be a professional real estate investor, that this is a business, this is not a game you're playing. Right? If it's just a hobby for you, then it's different, right? Then you putting money out of pocket is fine because that's a hobby. But if you look at it as a business, if you're doing a flip, meaning the back end value, meaning you have about $200,000 invested in the property, you better be making $40,000 in profit. In profit. That doesn't mean that if you've paid cash for it and then you don't account for the cost of money. I'm saying profit after expenses. Expenses meaning selling expenses. Expenses meaning, so if you're a real estate agent and you sell your own property, you have to be taking out that cost, right? Because you're doing the work. So that is an expense to you. So it's important to understand that that you got to keep that in mind. It's really important. So in net profit, you need to be making about $40,000 for it to be considered, hey, that was a great flip that I did. That was a good flip that I did. If you're making $30,000 on a $200,000 sale or $220,000 sale, I think that is, you're shortchanging yourself. That's just my personal opinion. I think that's a little bit less. I would not be happy with it if that was me. On a $300,000 property where they have all-in cost of about $280,000 to $300,000, I believe a minimum profit needs to be about $50,000. $60,000 is to be ideal on a $300,000 property. On a $400,000 property, the profit better be close to about $75,000 to $80,000 on a $400,000 property. If it's a $500,000 property, the profit needs to be about $100,000 on a $500,000 property. Right? You can't be flipping a property at $500,000 and only making a profit of $50,000 and be happy with it. I think that is a terrible margin. And I want to be very cautious when I say this. In less than 6 months, 6 months or less, right? Not in a year. You can't be doing a $500,000 flip and be making a, $50,000, $60,000, $70,000 and going, oh my God, that was great. That is not great. That is terrible as far as I'm concerned, right? As a professional real estate investor, meaning as somebody who runs a real estate flipping business, that is not good. So on a $500,000, you need to be making a $100,000 profit in 6 months or so. If you're not, then you should not be really looking at that property as a proper, it's not a good deal as far as I'm concerned, right? It's not a great, now have I done a lot of properties where I didn't make those kind of numbers on those? Of course, right? Of course. But I never called it a great flip, right? It was, I just did a property actually sold a property in Bellwood. On that particular property in a year and 10 days. In a year and 10 days, I made a profit of about $51,000, right? I was not happy at all with it. The sales price on that was $245,000. I was pissed at myself and the given situation because in a year on a $245,000 sale, right? I'm only making $50,000. That's terrible as far as I'm concerned, right? Now, some people will be like, Andrew, you're out of your mind. I think you're out of your mind, because you really don't understand investing. And if you're not doing those numbers, then I have no business trying to tell you that, hey, oh my God, I'm a successful investor, right? Making $20,000, $30,000 on a $250,000 sale is silly. It's just silly, doesn't make any sense. But that's just my opinion. Now, $600,000 better be $120,000 or more, and better be done in 6 months, 6 to 7 months, because as the property size gets bigger, you're going to have to do more rehabs. You're going to be more pain in the butt. Today, I had a conversation with somebody that's actually from Brand New Mastery, happens to be a very successful builder, and we were laughing about it because what he was talking about was a very interesting thing. He's like, man, in our business, if we're basically putting out about $2.5 million out of pocket, you have about 10 or 12 million in sales, and then I make about $1 million. That was considered a huge win in his business. And I'm like, those numbers are terrible to take up that kind of risk. And he came to Mastery just now because of that reason, because he's like, yeah, that makes perfect sense, because nobody looks at the amount of money you have at stake, right? You have about almost $2 million at stake to be able to only make $1 million in profit, right? That makes no sense as far as I'm concerned, but yet that is the normal builder that is out there that is doing building. And this is a successful guy. So I'm not talking about, this is not somebody who's not successful. So the numbers that we want you to hit are much, much higher than what is considered quote unquote good in the industry. And if you are watching this, you're looking at what a successful real estate investor should be doing, not just something what is average in the industry, because the average in the industry sucks. So just my opinion. Okay, what is the next one? The next one was, the last question was that the rentals are in a decline, meaning the rate of rentals are in a decline in terms of that the rents are coming down. So what is your opinion about that? I'm like, number one, in Chicago, the rentals have not come down. The rents have not come down. In fact, in Chicago and Philadelphia, the two big, in Chicago and Philly are the two big markets where the rents went up this year, right? They did not come down. Rest of the country, if you look at Florida, look at Georgia, you look at lots of parts of Texas, a lot of other parts of the country, the rents have gone down. Now, having said that, they have not gone down drastically, right? Nowadays, the media cycle is an extremely sick cycle. So where it's like, if there's an adjustment of 1% or 2%, oh my God, it's terrible. Oh my God, everything is going to hell in a handbasket. It's not, right? This is all nonsense BS that the media is hyping up, that if the, guys, rents had gotten out of control. They're out of control here in Chicago. But guess what? The taxes have gone up, the property prices have gone up, the interest rates have gone up, everything has gone up. So the rents have to go up in commensurate with that. Now, in a market like Chicago, the rents have gone up higher relative to the property prices, to the taxes, to all the other things, right? To the interest rates. That's just a fact of life. Why? Because the supply of rental properties in a Chicago market is not there. It's just not there. Why is it not there? Because there's no new construction in our market, right? You just can't build anymore. The density is already that high, so you can't build anymore. Now, you look at Florida, in all the areas where you can do a lot of new construction, a lot of new construction was done. In those markets, the rents are being obviously coming down a little bit. Why? Because you have a lot of supply of properties available. You go to something like Sarasota, right? You go to that area, the rents haven't come down at all. If anything, they've gone up. Why? Because in those particular pockets, there's still a shortage. But right next to Sarasota, as you start going out to a little bit outerlying areas, there's a lot of supply of properties. In those areas, when there's a lot of supply, your rents are going to come down, right? When there's not enough supply, your rents are going to go up. That's just a basic fact, ABCs of anything. Supply demand is what controls all of this, and not the interest rates, right? The interest rates are higher, but continuously the the rental demand has gone up because there's just not enough supply, and that's the reason why the rents have gone up. The last question I want to address before we wrap up for today, and that one is that I'm a new landlord. How do I start increasing rent on my tenants without losing them? So it depends. I mean, this is an interesting question. We tend not to be very aggressive on raising rents because I genuinely believe that we want to have long-term rentals now and long-term renters, because each time you have a turnover, that's where you basically affect your bottom line terribly, right? And so I want people to stay in our properties minimum. So we don't do anything less than a 2 to 3 year lease. You heard me correctly. On a long-term rentals, we do a minimum of 2 or 3 year lease. Now, who is going to come there that's going to sign a 2 year, 3 year lease? People who don't want to move, right? People who want to basically stay there. And so if you're renting it at today's rents, even if next year I didn't raise the rent, it's okay. Why? Because I'm not touching the property. Each time you touch the property, each time the tenant goes in and out, there's a cost associated with it, and that cost is not worth it. For us, generally a tenant stays in our properties a minimum of about 5 years. If you look at the average, some people are even higher. So if you are a new landlord, what I would suggest is this. I would not just suggest and go give them a huge increase. Now, if you have not done a rent increase for the last 5, 10 years, 12 years. There's a lot of landlords that go, oh my God, they're nice people. They've been with me, or I inherited them as older tenants. Guess what? These people have gotten used to low rents, and probably you're not going to be able to increase rents on them. Because why? Because you've basically just spoiled them. We have all done this in different ways of our lives. And if we spoil people, then guess what? They have a tantrum when you basically want to make it fair, right? If you're going to make them pay a fair rate, they're just going to not like it because it's like, oh my God, this is not fair. You're suddenly charging me too much, right? So what I would suggest to you is that I would reach out to them and say, hey, listen, my insurance has gone up, which is the truth. My taxes have gone up, and the interest rates is up. And I am having a hard time affording the property. Doesn't matter if you are or not. This is what the line I would use. You got to mentally get them ready and then gradually start raising kind of that rent if you don't want to lose the tenants. But if you do a sudden raise on them and the tenants have just kind of gotten used to a low rent, or that's just all they can afford, then you are going to lose them. But I would not just suddenly spring on them that, oh my God, you're going to give them a $100 or $200 increase, because that may not be something that they may be able to swallow that pill, and they may end up moving out. So I would reach out to them a little before the lease expires, right? And kind of start warming them up to the idea that, hey, they're going to end up with a rent raise because it's not you, it's outside factors that are affecting your ability to be able to own that property, and you feel terrible, but that's just how it is, right? So that's kind of the way I would do it. Now, if you haven't raised rents for a very long amount of time, it may be time for you to clean house and bring the rates to a to what the market rent is today. But don't compromise that and get bad tenants just to charge market or a little bit over market rents, because then you're compromising the quality of the tenant. They're going to take a toll on your property. Hopefully, all of that makes sense. Having said that, thank you again for joining. Please share the group with your friends, with your family, with other fellow investors, because that's how we all get to grow. And again, if you have any questions, even if you're not in Mastery and you want us to take a look at a property for you and say, hey, what is your opinion? Right? We're happy to share that. We're not going to give out, obviously, your address because that would not be ethical, or that would not be right. But we would love to be able to do the analysis. It's fun to be able to share actual properties that are going on. I'm excited about this particular property that this person from Mastery is looking at, that we were talking about today. I think they're going to make actually a lot more than $30,000. My numbers, I looked at some of the comps. I think it should be about a $70,000 to $80,000 in profit. So I'm happy for them. But it's always fun to be able to share that. Having said that, thanks a bunch, and we will talk to you on Friday. Remember, we're going to have Rahul answering some questions on Section 8 specifically on Friday, and I'm going to try to have Ms. Gina address some of the eviction issues, some of the questions that have come up. Having said that, thanks a bunch, and talk to you soon.